Great. Evening, everyone. Well, evening in Dubai and in Pakistan and in the Middle East in general. Late afternoon, I guess, in Europe. Early evening, and look forward to also speaking with our Park Launch members in the United States and elsewhere in the world. Anyway, so the subject is a fairly specific one, and I think that the conversation really came out of a discussion I had with Ali, I guess in London a while back when we did the unconference, really centered around momentum that we're beginning to see around the IPO road mapping of mid to late stage companies in the MENA Pakistan region. What's interesting is that if you look at the Turkish IPO market, it's been very, very buoyant this year. A lot of liquidity going into initial public offerings, and a lot of momentum in the Saudi market, especially around IPO, particularly listing both of traditional and tech businesses. And you're starting to see quite a lot of momentum, if you're here, around the interest and attractiveness of listing in Saudi Arabia. Now, obviously, the interesting part of the conversation is also around the track record of IPO listings of Middle Eastern companies in Europe and in North America, which has been somewhat checkered. And we'll get into that in detail as well. The other thing to note is, as I said, the momentum that's taking place in the MENA region and in the GCC is proven out by things like Tabby, the buy now, pay later player in the GCC region, which has announced 2 or 3 weeks ago its relocation to Riyadh from Dubai, and the closing of a recent round, if I recollect, of around $200 million. So quite a lot of momentum taking place. 2 listing opportunities in Saudi, Tadawul, which is the main market, and Nomu, which is the, I guess, equivalent of the smaller AIM type market equivalent in the UK, which has also seen some tech listings taking place. Around 5 IPOs so far in Riyadh this year, something of a pipeline for more. And depending upon who you talk to, there's a pipeline of probably about 20 or 25 companies looking to list in Saudi Arabia. As I said, both traditional groups, divestments, tech companies from the region looking to list, et cetera, et cetera. A few candidates, and we'll go into some of those names as well. Now, the one thing Martin and I have done as well is to have actually the beginning of an initial conversation with PSX in Pakistan, not necessarily the subject of today's conversation, but we're very keen to ensure that what initiatives take place in the IPO sector from a readiness and preparedness perspective, we can map those opportunities to capture knowledge and apply those to the Pakistan market as well, because that's when a platform like Park Launch becomes valuable, where we can take our learning and experience and apply it to Pakistan and vice versa. So, I guess most people will have seen me before. I've done a bunch of stuff with Park Launch and enjoyed it thoroughly, Corridor series, etc. My name's Ovais N. I'm a partner at Rise Capital and have begun, I guess, a couple of years ago, launching an advisory business called Clear Mountain, particular focus on commercial due diligence capabilities for funds, looking at tech opportunities in the MENA region and in Turkey, and also looking specifically at value creation planning capabilities, growth planning capabilities for technology companies in the region. So there's a natural expansion of, commercial due diligence and value creation planning type activity, and expanding that into IPO readiness, which is our interest in the space. So I'll hand over to Martin. Martin will give you a quick intro as to his background. He's had a fantastic career in public markets in the UK and Europe, and more widely geographically as an advisor, as a stock exchange board member in many geos. So we'll do a quick intro to Martin, and then what we'll do is pick up a series of questions, keep the questions coming in, and Ali will direct those on the chat. But I'll hand over to Martin, and then we'll go from there. Welcome, Martin.
Hi, guys. Good evening, good afternoon. So my background was I started life as an asset manager, then I had quite a few senior roles in investment banking. I used to run global equities for Dresdner Kleinwort Benson when it dominated the European equity market. So I had a lot of involvement in IPOs as a banker, advisor, distributor, talking to the most important investors on earth. In 2002, I was headhunted to a new role at the recently demutualized London Stock Exchange. So my job was director of markets and head of AIM, which was the junior market. So I had direct responsibility for 80% of all the group's profits. And also one of the most important parts was me spreading the word internationally. So under my leadership, the LSE had 20% of all global IPOs for a long time, and AIM became a global market, raised more money than NASDAQ. So I spent a lot of time talking to companies about listing, particularly in London. And the reason they were listing was they were showing they followed the highest standards of corporate governance and they could link into global investors. I was also in charge of all stakeholder relationships, which included all the investors, all the companies, but also things like global exchanges and regulators around the world. So my exposure to IPOs has been as an investor, as a board member in a company, as an advisor, as a stock exchange, and also as a regulator. So I think I've got a genuine 360-degree perspective on the whole process, which I don't think many people actually can share.
Fantastic. And tell us a little bit, Martin, about some of your international experiences and geographies in which you've done stuff outside of the UK.
Yeah, so when I was at the LSE, I spent I worked in European equities, but a lot of my client base was in places like Japan, the US, Singapore, etc. I used to run big relationships as investors. In terms of stock exchanges, obviously I've done a lot of work with the German stock exchange, the Italian stock exchange I ran, as well as London. I was a board member of the Moscow Stock Exchange. So I've had a huge amount of international exposure. So since I left the exchange in 2010, I spent my time advising governments and particularly regulators on strategic regulation, how to build new regulatory models for new markets, particularly digital markets. So I think I've got a large amount of international perspective, and I've seen in my career some spectacular successes through the IPO process, because I think it's a great process, but also the wrong kind of companies IPOing and the thing not generating values it should, but also potentially destroying a lot of value.
Yeah. So tell us one thing, just from a definitional perspective, Martin, just, ensuring that we equalize knowledge among everybody on the call. Take us through, what is the definition of an IPO as opposed to any other?
So very simplistically, and yes, sorry if I'm teaching people to suck eggs. An IPO is an initial public offering. So it's the sale of a company's shares to the public and the listing of its shares on an exchange. In fact, technically, you list with the listing authority and you admit to trading on the stock exchange. And it doesn't mean you have to list 100% of your shares, but most markets have minimum requirements. In London, it used to be 25%, now it's only 10%. And obviously, the IPO is not the ultimate objective. The whole thing is this is about transitioning to be a public company, working in the interests of all shareholders, all the kind of reporting and transparency that requires.
So it's important to recognize it's not the listing of all the shares in the company. It could even be a relatively small minority.
Exactly.
Yeah. Okay.
And also now you can have different share classes with different enhanced voting rights. So it varies completely by market. But generally, to make an IPO a success, I would say you need to have at least a 25% free float, because you won't have any secondary market liquidity if you have too smaller free float.
Understand. And in terms of definition, you've got a kind of, I guess, a full listing, you've got a IPO, you've got a DPO, direct public offerings. Draw a distinction, if you can, between an IPO and a DPO.
Well, so a DPO is where you go direct to the public. With an IPO process, you have an intermediary, you have investment banks that underwrite, and you admit to trading on a regulated exchange. With a DPO, there are no intermediaries on underwrites. You go straight to the public who you sell to. You don't have to have a full prospectus. Within an IPO, you have to have a prospectus, which is a legal document, which has to be agreed by the regulator. You have to have some documentation within a DPO, but not a formal prospectus. But the big difference is with a DPO that you don't usually trade on a regulated secondary market. You trade on an over-the-counter market. So you don't really get any secondary market liquidity.
Okay. And in terms, Martin, of, the stack of advisors and the process, I mean, let me take you through a hypothetical scenario, where I run a Series C funded tech business. I've raised I don't know, 80 to 100, 120 million bucks. The discussion around exit optionalities coming to the board, instigated either by the board or by me, a requirement for liquidity from some investors in terms of a holding period, getting to 5 or 6 years of investing in my company. Everybody kind of thinks there is a peak opportunity given market conditions, given the appetite for this particular type of investment in this type of industry. What is the typical process that boards and company management teams go through to start initiating the IPO discovery process?
Well, I mean, the most important thing to start with is to actually assess whether the company is prepared for an IPO. And that's looking at all sorts of things within the company. The most important thing to me, several most important things, but critically, the company has to be ready to be a public company. It has to have the right kind of systems and controls in place to fulfill all the reporting requirements, which are getting more and more onerous. It has to have strong governance, which is suited to being a public company. It has to have a board and a senior team who have got the right kind of capabilities, which is something we might want to come back to, which is critically important. And above all, they have to have a strong equity story. And that's around, because we're talking about a competitive market. Okay, you've got other companies who want to raise money. You have to be differentiated in terms of your competitive advantage, your scalable business model, your track record, the quality of the people that work with you, because that's the kind of thing investors will look at. So you need to assess all those things as a starting point. So that's as an initial think about where we are phase, and you have to identify the gaps. So people like us go in and do that for companies. So it's a very thorough process. You then have a preparation process where you go through all the kind of documentation. You need initial investor engagement, which is a very strategic thing. So you go through a lot of preparation. Then the execution process, which is all around having all the legal documentation, all the accounting reports in place, and then you start the formal marketing of the IPO. And that there's a lot of nuance in that in terms of which investors you target, which syndicate members are underwriting your IPO. So you go through all the execution, and then you've got the post-IPO where you have to act as a public company with strong investor relations and all those kind of things. So basically, it is a very complicated process. To make it work properly, you need to have huge amounts of preparation from day one, from the initial idea, through the preparation, through the execution, through to being a proper public company. Do you want me to take that question about common pitfalls? So I think that's quite an interesting one for them.
Yeah, sure.
Okay, so my view is an IPO should be a wonderful thing, but in a lot of cases, things can go wrong. And all these things I'm going to list could be turned into a positive, all right? So you do often, I see, get very poor preparation and very poor timing from people, and that's probably because they are very, very badly advised. You get cost overruns, particularly because you're not managing the advisors properly, who just care about doing a transaction and charging the company the most they possibly can, and they're not necessarily aligned. You get a wrong valuation, and that's often, you have got overvaluation, but it's often the case of undervaluation, tend to under pricing your equity historically, so that's in the sort of 10 to 15% range, and that's down to the syndicate structure not being right in terms of the underwriters not having the right competitive tension and the equity story not being properly differentiated. The worst thing which happens is that the company aren't ready to be a public company. They don't understand how to operate as a public company, and that includes having the right kind of board in place, the governance structures, the reporting structures, and being skilled at investor relations, because you have to engage investors at a very early stage, strategic investors who can understand what you do as a company, who can support you, because it's not just about the IPO, it's ongoing. I mentioned obviously board and senior management. You often get suboptimal market choices and poor timing, and you also get people not having proper relationships with regulators, and that causes huge amounts of issue, because when you come to the execution, if you have to keep resending your prospectus to the regulators because you don't understand what the requirements are, that takes a lot of time and cost. So all those things which lead to overruns on costs, undervaluation of equity, can lead to, rather than actually benefiting from an IPO, which is a great thing in my view, you end up with all the obligations, but none of the benefits, and you have huge reputational damage. And you end up with a liquid stock and angry shareholders. So you can destroy a lot of value. But if you do the things I mentioned properly, you can create massive value.
Yeah, just to zoom out a bit, Martin, and we'll deal with some of the questions later because they'll take us out of sequence. But in terms of, you know, the cyclical nature of public markets, I mean, you know, I guess for me, from experience, one of the big challenges is timing, because, you know, you tend to have to time a listing when there is a, I guess, maximum capacity to attain a good price, and when the market is likely to respond positively going forward, because you'll get to it in a second, but obviously management have things like holding periods whereby they can't sell their stock immediately. You've got to hold the stock for 9 or 12 months before you as a management team can exercise your right to sell, ditto certain investors. So how does the cyclicality of the IPO markets impact what you're describing? Because you hear about, you know, North America slightly, you know, down on IPOs, or Europe's up, or Saudi Arabia's bullish. You know, how do you see all of that peculiar? How does that play into thinking around IPO timing?
Well, I think you have to have you need to, it's not just IPO time, it's market selection. And you can do a dual listing, which I'm sure we'll come to, but market selection is partly, that has to link into corporate strategy, or kind of go-to-market strategy. Because if you have a successful IPO in a particular market, that has a huge impact on your company perception and your reputation. Okay, so it's almost free advertising. I remember I persuaded Air China to do a dual listing in London when I was at the stock exchange, and it just totally changed their business because everyone knew about Air China, no one had ever heard of them before. Okay, so it's partly market, and different markets are doing well at different times. Okay, but the timing is really important, because you can, at the moment, it's not easy. Okay, we've got a lot of economic uncertainty, and you've got bonds being more attractive as an asset class. So the picture's mixed. But having said that, this year's been a lot better than last year. But if you look at the US, I mean, the US is doing twice as well as last year, but it's still 85% down in the first half from 2021. So we're seeing a pickup. We've seen some positive signs in the third quarter, but then a lot of the companies, the big companies coming to market in somewhere like the US, you look at Arm, you look at Instacart, you look at Birkenstock, they now trade below their offer price, which isn't good for IPO markets. So I'd say, I don't want to sound negative, but you have to get the market choice and the timing right. One really interesting thing this year, actually, is I keep talking to people about how they allocate their equity on an IPO. One of the most successful IPOs is Carver, which is in the US, which is one of the largest IPOs, which is 20 times oversubscribed. And because they went for a much wider investor base, the secondary market is much better than some of the other issues which have gone for a very concentrated investor base. So there's all sorts of nuances to this process. And I think you and I, Ovais, have seen it so many times. I think that knowledge is there, but people have to understand why it's complicated, and they have to ask the right questions. But the short thing is, I think 2024 will get a lot better. I see that the quality of the pipeline is there globally. But at the moment, the picture is very mixed. So the real point is, it's going to take you maybe 12 to 18 months, if you do the thing properly, to be prepared to be a proper company, to be at the stage where you can actually legit properly do an IPO and make it a success. You don't want to come too early, because that will just you might as well wait a year rather than come too early, because that will, even if the market conditions are looking good, because often we've seen the wrong companies floated in a market where everything's looking good, sort of the rising tide floats all the boats concept. That leads to a complete disaster. So number one, you have to be ready. And then once you're ready, then you need to take a tactical view on the timing. But there's no point, you should start getting ready now if you're thinking about IPO, because it's going to take you 12, it depends what state your company's in. If you manage the process really well, you can do it in 6 months with the right advice, in my view. But in most cases, it's going to be 12 to 18 months, even with good advisors and people like us holding your hand.
Yeah. So just a quick one. In terms of, pricing, take us through the dynamics of pricing, because there's a question around overvaluation of tech stocks. And you see that standard pattern of like a pop in the share price immediately, a lot of profit taking, and then, the company may well struggle to actually justify the initial price. I mean, take us through the dynamics of pricing and how you get it right.
Well, I mean, what happens in real life is you have a syndicate of banks who become the underwriters, right? And they want to get the ticket to sell the equity because that's how they make all their fees. And they have investment analysts who write a report talking about the prospects of the company, and they can use all sorts of parameters. We don't want to go into some economics here, but some of the DCF models are just a bit of a joke sometimes. And if Goldman Sachs said a company is worth 2 billion, Morgan Stanley might say it's worth 2.2 billion because they want to get on the syndicate. Often you have several people in the syndicate, clearly. So it's a bit like an estate agent, so they can sell your house for X to try and get you to take it. But you have to have somebody with a bit more sense. And it also has, you have initial, as I say, you need to get to know some investors initially. Some of your early investor people will have some input into the pricing because they'll have a deep understanding of the prospects of the company, hopefully. So you come to a sensible range, okay? And then it goes into an IPO roadshow. You go out and see investors, and you have a book building process. And the investors are really the arbiter in the end because they might want to get equity, but they don't want to overpay. So it's some kind of market process in the end. But generally, things get underpriced, I would say. But you get when things are really in fashion and all the investment banks want to get on the ticket, they overdo things, right? And they go to an awful lot of short-term. Well, they might go to the wrong investors, I'd say. But that's how the process works. It's a book building process, and the investors. The key thing is how you structure the syndicate, what balance of people you have in the syndicate, how you manage their different interests, and how you target investors, and then at the end, how you allocate the equity between different investors. And the problem is, if you just left it to the investment banks, they just want to allocate the equity to the people that pay them the most commission during the year, do most business with them, and they're not necessarily the best investors. Because the essence of all of this is an IPO is part of a company's growth strategy, a continuing growth strategy. So having strategic relationships with good quality investors, they're the people who are going to start funding future growth and helping supporting you in M&A activity, etc. So getting the right relationships is critical. That's why part of being a public company, which people often underemphasize, is the investor relations capability in a company. And that's from the board downwards. You need skilled professionals doing that and advising on that. Because if you don't do that right, you just throw away a lot of potential benefits.
Yeah. And in terms of, we saw, I guess, about 2 years ago now, a significant boom in the fashion for SPACs and how some of those things have blown up subsequently. We'll get to one of them particularly.
Mm-hmm.
But, tell us what a SPAC is and how that kind of happened and how it seems to have disappeared just as fast.
Well, it's a special purpose acquisition vehicle where basically you just give loads of money to, rather than just go through an individual company IPO, you just give someone you think's clever lots of money, and then they agree to invest that money in companies on your behalf or a company. And it was just a massive bubble. It's the same as ICOs, the same as all sorts of things. It was a case of where there was too much money chasing too few opportunities, and everyone thought they could get rich quick. But those things never survive in the longer term, in my view.
Yeah. And in terms of, your experience that's obviously building over time in the MENA GCC region, take us through a little bit. I mean, I'll set the context if I may. You've got, as I said, a lot of increased tech sector IPO momentum in Saudi Arabia. Let's not forget, traditional listings with traditional sectors, oil and gas, etc., is still the mainstay of what we've seen in the IPO space. Aramco, I think, still very much dominates the IPO story in the last 5 years in Saudi Arabia. But you're starting to see a lot of engagement by Tadawul and by Nomu around engaging tech sector companies. And you're starting to see a pipeline developing in Saudi. And you've seen, issues like Swivel, a famous example now, unfortunately, of a relatively nascent tech company in the B2B transportation space, buses, expanded from Kenya to Pakistan, through the Middle East, acquiring a company called Volt Lines in Turkey, pops at $247 at launch and is now sitting at about 92 cents, if I'm correct. So tell us a little bit about, where you see the region, and then, we can apply some of that knowledge to where we might be able to see a Pakistani picture evolving in the public market space.
Yeah, I mean, as you quite rightfully said, Aramco dominates everything. But I do think, and we've seen some disasters, I do think there was a very healthy pipeline. I mean, the UAE was the best. The Nasdaq Dubai, I think, did a lot of sukuk issues in the third quarter, didn't they? But you've seen some disasters in Saudi. There is a very, very strong pipeline. My problem is, I'm worried that some of those companies will list too early and they're not properly prepared. And the thing about a market is, you can buy any market anywhere using your phone, but you only go to a trusted one. And if you start damaging your reputation, you've got a problem. So theoretically, there's a very, very healthy pipeline. And I think obviously all the 2030 agenda in Saudi is impressive. It should be one of the best. It should be one of the best IPO markets. But I think people need to make sure those companies are properly advised that are coming to do an IPO. And I've seen a lot of it. My experience in London was I said I was responsible for the internationalizing of the market. So we had a period in 2003 in London. We had 8 international IPOs. In 2007, we had 95, and in 2008, I think we raised well over $100 billion. So we're the dominant international IPO market, and also, as I mentioned, Air China, all sorts of companies all over the world were coming, and they worked. But there were some notable disasters, companies which came too early, particularly in the junior market, because they weren't properly prepared to be public companies. And I can see exactly the same trends happening potentially in the GCC region.
So how do you bring an independent lens to the process? Because, if I'm a founder and if the board is, suggesting here's a path we should start building a work stream out of and start developing our planning capability, our readiness, or at least due diligence, the IPO path. I mean, obviously, it sounds like, if I no disrespect, if I go to a Goldman or a JP Morgan, they're probably potentially going to tell me, hey, great idea. If the idea doesn't come from them, then they're going to endorse the idea. And the net result is a lot of the momentum around listing. And we'll take one example in Europe that I've been involved in recently, which we'll talk about. But, a lot of the momentum comes from banks. It comes from people pushing CEOs into a liquidity opportunity, because it's very attractive to say, do an IPO and you can release 75, 100 million bucks for yourself and for the selective early shareholders. What's the 90-degree perspective how do I get an independent view as to whether it makes sense for my company or not?
Well, my view is you hire someone like us.
Yeah.
Is the biggest. No, I mean, the problem is there are all sorts of conflicting interests, right? So to make the thing succeed, I think you need 2 essential things.
Yeah.
Right. You need to, number one, have someone that can actually assist, work in partnership with the company to project management, that entire end-to-end process from the original idea to through, as I say, through preparation to execution to acting as a public company. Okay, advice on that, because all the banks are interested in is transactions, and they're very skilled at doing that. Okay, and then get you a great price and do a good job in analysis. So you need that, and not many people understand. It's such a complicated process. You need to understand a lot to be able to do that well. But the second thing, which I think is equally as important, is what I call the value defining decisions. So some things I talked about which go wrong. If you get your decisions right on timing, whether you've got the right board and senior management, which markets you choose, you need somebody who's got the depth of knowledge to actually help you make those strategic decisions that define the value. So I think that's what you need. Someone's independent that can both do project management and both be a key part of the strategic decision-making process and work as partners with you. And also to do that, because there's a lot of regional nuances, you need somebody that actually both understands all the global best practice, but also gets some of the local pinch points.
Understand. So find good independent advisors. A couple of other questions I'll tackle which have come in. Let's tackle the dual listing question, because it's come in the context of PSX in Pakistan. But tell us a little bit about, you're starting to see, Martin, companies like Retailer, which is a B2B e-commerce player in Pakistan, expanded into Saudi. So you're starting to see companies with, certainly with UAE Saudi footprint, that's pretty much a prerequisite for investing in a GC business, has it got a TAM in Saudi. But you're starting to see a little bit of overlap around, UAE Pakistan and Saudi Pakistan companies. So, those are potential dual listing opportunities. Tell us a little bit about that as opposed to a single market listing.
Well, let me tell you from the big picture of this, why it makes sense. Okay. Because 90% of companies do list on their local markets. That's the benchmark. Dual listing in a different location, it could be a global exchange, right, is a very good idea if it's part of your go-to-market strategy. It gives you huge profile in another geography. It also gives you access to new investors. And the fact that you've follow the listing standard of a London Stock Exchange, for instance, shows that you actually follow global best practice, and that does have an impact on your cost of capital, and that's very significant going forward. Okay, and there's all sorts of things around time zones. So most companies, there are different ways of dual listing, which is probably, this is just a technicality, but most people do a local listing and a depository receipt. Some people do a cross listing, which is the same stock in different markets. The downside of dual listing is, of course, you need to maintain regulatory relationships with more than one place, and that takes up cost and management time and investors. But if you've got the investor relations working properly, that shouldn't be a problem. It should be a seamless process. So what I see more and more is, you mentioned Riyadh and Abu Dhabi. We had Dar Al Arkan, which is last February in London. I think it raised 1.2 billion, which is their global unit from Saudi. I know that the Saudi market's talking to Singapore, Egypt, Qatar, all those kind of places. But yeah, I mean, a dual listing can be a phenomenal waste of time and a waste of money, and people just do it for ego reasons. But if it's aligned to your strategy and you're set up properly as a public company with all the kind of capabilities and investor relations, it can generate a lot of value.
Understood. And in terms of, IPO cost, because, one of the things you see is, suddenly a tech Series B, Series C, Series D company, or a traditional player in the transportation logistics space or in oil and gas, you're suddenly talking millions of bucks in advisory fees to do an IPO. How do you manage that, and what's the expectation level around the cost?
Well, that's a good question, because advisors will charge you a lot of money, right? So if you talk about if you go through the cost of doing an IPO, you've got the underwriting straight distribution costs, which are 4 to 7% of proceeds.
Yeah.
You have, in some markets, sponsors who charge you $1 million. The accounting fees can be up to 2, legal fees can be up to 2. Then you've got the listing fees, which are pretty irrelevant relative to the things I mentioned before. And then you've got the regulatory expectation or application, and you've got hiring an investor relations expert. So we're talking about millions, right? So they can seriously undermine value maximization. But my view is the way to manage costs is to have someone independent that actually manages the advisors, appoints the advisors in the first place and manages them, and creates competitive tension, who understands where advisors go wrong, also who understand regulators so they don't waste lots of money. As I said earlier, sending the same documents back to regulators over and over again. And also look at documents before you send them to a lawyer. So they're in the right state. Make sure the timing works right. So we're the kind of, we know how lawyers work. Sometimes you need to kick them because they've got too much work on. You need someone that can be your kind of external helper that makes that happen quickly. Otherwise, you just get all these overruns. So it is expensive, as well as what I said is, so you've got all those costs. You've got the potential underpricing of the shares, which can be, well, I think the last Harvard Business Review that was wrote about it, we were talking about 10 to 15% underpricing. So that's an extra cost in reality. So yeah, you have to have forensic attention to cost, create competitive tension, make sure all the interests of everybody are aligned.
Yeah. In terms of a critical subject, which is board governance, let's step back a second. I think, one of the big challenges that I've seen in the region and generally has been, and you see it blowing up all over the place. You see it even with FTX, You see it with Twitter. No disrespect. You look at the Twitter board before it became X, before Elon Musk acquired it, and you take a look, and no disrespect, you kind of go, why are half those people on the board of a social media business? They've got no direct relationship with the industry sector. It would appear no deep domain knowledge. And then you take FTX, and no disrespect, I mean, half the board clearly don't know what's going on. How do you avoid the pitfall of having a dummy board or a board which simply doesn't have enough expertise in the core business?
I think it's quite simple. I talked about the initial assessment that we would do as best practice, and part of that is actually looking at the competence of the board and management. And what I see time and time again is two things missing when it comes to boards. The first one is what you kind of just touched on, which was the deep domain expertise, understanding how the company really works. Right, because often you've got a chief exec who just has a few of his mates. You get some good guys who might have been some of the VC funders, but they tend to be people that do it for 30 different boards. So how on earth can they do it properly? So that's one area where you need to get the right people with the domain expertise. And also things like a COO who can do the investor relations. The second thing which I see time and time again is bad risk management, and risk management becomes more and more of a differentiator going forward. So, I mean, I've chaired the risk management committee for investment banks, also the Moscow Stock Exchange, and it's incredible, very intelligent people. When things go wrong, are like rabbits in headlights. And typical risk management processes are looking backwards rather than forwards, not being strategic, not looking at what's going to happen in 2-3 years' time to regulation, technology, etc. So you need board members who understand key parts of the governance process, particularly audit and risk. And those individuals aren't always easy to find. Okay, so you need somebody that's got a global network and find the right people for you. So my view very much on the board side is you have to be, in the initial appraisal of whether the company is ready to be public or where it is in the IPO process, you need to be very candid about the capability of the board and the management team. So you need someone independent on the outside that can actually do that appraisal for you, and then take some remedial actions. And it's much better to do it early because you need to have the right board on board, engage at an early stage, because that has an impact on the initial investor conversations you have. It clearly has an impact on what people are going to pay for you when it comes to valuation. It has an impact on, is the board strong enough to actually have clarity around the equity story? You need a very, very clearly articulated equity story. If you have a board that don't really understand the business, that's not going to happen, or they won't challenge things properly. If you've just got some charismatic chief exec who's just done what he's always wanted to do with no one challenging him, which can be equally damaging.
Yeah, I mean, it's certainly the most common risk issue that I've seen in companies that we've invested in and along the way in other platforms is really the challenges of finding a value additive board that has appropriate domain subject matter expertise across both the core business and other areas which are relevant to the company's future, including public markets and including, for example, corporate finance, or including even strategic partnerships or M&A opportunities globally, where the expectation has to be that at least one or two of the board members have, accretive knowledge of how an exit path might form in that particular industry. And the trouble is, one's experience has been, and it's slightly concerning because it hasn't changed in about 10 or 12 years, is that you look at boards, you look at the construction of boards, you look at the default, which is you're a shareholder, you get a board seat, you're a bigger shareholder, you get 2 board seats, 2 board seats, board members get bored, put an associate director on the board, eventually the tea lady's on the board. And then the net result is you've got this enormous dilution of the actual quality of board conversation. And then when you look at the risk of that as a private VC held company, that's high. But when you look at that from a public markets perspective, it's a disaster scenario, which results in WeWork and FTX, frankly.
I totally agree. And the other thing to add to that is what I mentioned earlier on about the kind of things that a company needs to support themselves, apart from the project management, is about the strategic decision-making process, making the right decisions, Okay, the key decisions, and part of those around optionality. So obviously we help with people having proper optionality when it comes to those decisions, the service we provide. But the IPO isn't the only route. Okay, it's one route around value maximization. I think it's a very good route. But if you don't have the right experience on your board, most of them are going to be doing what they're familiar with. So one guy was saying, oh, let's just do a trade sale, let's do X, Y, and Z. They haven't got the breadth of understanding to make those decisions properly.
Understood. And in terms of, companies even ending up going private again, what's been your experience of that? Because you see it for stories, and not necessarily going private because they have to, but going private because sometimes they go, you know what, let's go private, and then, we did the public thing, let's go private, and then we increase our optionality for trade sale later. What's your experience of that?
I've seen a lot of that in smaller companies, and it's always and often ones which have been successful. Well, some because they're just a complete disaster, right? So that's because some startups don't succeed for obvious reasons, but mostly it's where people they haven't been totally ready. They've had a good business model, but haven't been totally ready, and to be a public company, so they've had problematic relationships with investors from the start. So they opportunistically go private again, but they've wasted a huge amount of time and money, in my view. But if you don't get it right from the start, you don't prepare properly, and it goes wrong, you might as well go private, frankly, because it's going to take you you can turn these situations around. But in a lot of cases, the company's been so unprepared to be public, had all the wrong people. It's not going to happen.
Yeah. I just think of an example, Aramex, which is, one of the region's leading logistics provider, was initially listed in New York. It went private, which we were involved in a previous incarnation, and then it subsequently went public in the UAE. So, unusual example of, and then went private again, and then got acquired by somebody else. But, you get these companies, and they're perfectly successful, but they've had an interesting trajectory.
You can go private, and you're not under the gaze of institutional investors. You can then sort things out. Hopefully, you've learned your lessons, then you can go public later, with proper advice and preparation. All the things we've been talking about today.
Absolutely. Well, we'd have to talk to Fadi Ondur about that, but I think that was one of the big drivers was, taking it private, doing a whole load of growth planning and refixing, and then listing in the UAE market. Now, there's one subject, Martin, which is critical, which is, again, from our collective experience, and I'm sure the experience of other people on the call, is, there's obviously a degree of momentum. So, you're sitting there as a board, you're sitting there as a CEO, you got Goldman involved, or JP Morgan, or a combination, and you've got a book building, and you've got a ton of investor interest, and you're looking at a dual listing in London and Hong Kong, and it all looks very exciting. And obviously energy creates momentum, and then suddenly everybody's excited. And as well as I do, that the music stops post-IPO. Once you've listed, I'm sorry to say, that's when the real hard work begins, and that's when the stuff starts coming out of the closet around your ability to cope. So take us a little bit through the post-IPO scenarios that you've seen, and what are the pitfalls and risks once you list, not just in the selection process.
All right, so the fundamental point is around, you become a public company and you have to work in the interest of all shareholders. And hopefully that is the new culture in your company. You have loads and loads of quarterly reporting requirements, regulatory and financial reporting. That's just got to happen automatically as a company, right? And you need to be able to have proper relationships with investors and manage expectations correctly. If you do that, it's a smooth process. But you can't just only do that as soon as you can't sort of think about that after the IPO. You've got to be thinking about it a year before, building up that kind of capability. So it all comes to preparedness, understanding what you need to do to be a public company. Okay, that's a very, very important thing. So a lot of companies, they think, oh, we can do an IPO, it's good for our ego, we'll take some money off the table. Isn't that great? But they don't properly think about how they need to operate, or all the systems and controls, risk management, including the quality of the board, actually, that comes back to that as well. And how the investor relations capability fits. That is absolutely fundamental. You get that wrong, you've got a big, big issue. So let's say, so you need to perform and manage expectation.
Yeah. Tell us a little bit about, I've got two questions actually, if you could just bear them in mind. One of them is around, specifically the pitfalls post-IPO in terms of managing the share price. Because, as we discussed, most leadership team members and CEOs will get their ability to liquidate their stock after a lockup period. And that lockup period, could be 9 or 12 months. So it's critical to sustain the share price above a certain level. Otherwise, management can end up making nothing. I think of an example, I won't name it, but let's just say an emerging markets e-commerce player listed in New York in the last 2 to 3 years. I happen to know it because I was an investor in it at the pre-public stage, and it's ended up, I don't know where the share price is currently, but like the other two examples I mentioned, it's sitting at about $1. Okay, so Swivel's at 92 cents, Sangami, Spotify regional equivalents at about $1, and this particular e-commerce company was floundering at $1 for eons. I know for a fact that most of the management team ended up making nothing, which is a very sad outcome for 5 years' work and for a whole kind of liquidation event that they and their families were looking forward to. So question one is, how do you avoid the pitfalls of that classic pop and bust syndrome in public markets? And my second question is the criticality and training and tutoring and mentoring, I should say, around narrative for CEOs. How do CEOs build their storytelling capability? Because it sounds to me like being able to tell your story really well is a key component of public market success.
Well, let me do the second one first, and that's just all around proper mentoring CEOs. Some people have got no idea. Okay, they might be brilliant CEOs, but they need to build a new capability. But it shouldn't just be the CEO. I think a lot of it has to happen through the CFO, who's probably might be more suited to that, hiring someone that's got that kind of experience as a CFO. And some of that can be, and you have to hire some strong IR professionals, in my view, who can help. But then also people like us who work as partners with companies can actually. I've always found you need someone that good CEOs need independent board members and outside people that they can talk to when they've got a problem without feeling scared about doing it, without feeling vulnerable. So I've had all sorts of relationships with subsequently in the LSE, I've been on all sorts of boards and advisory boards, and I work closely with the CEO and tell them that they need to focus on X, Y, and Z. And part of that is around communication and absolute clarity around what the equity story is. So you have to teach that, and you need help. Okay, but most people can do it and they get it. They're intelligent people, but they need to be able to put the time in, and the CEO needs to be able to block out X weeks a year to go and talk to shareholders. You have to invest the time. Okay, so it's learning and investing the time. Now, the pop thing is how you manage this. You can't manage your share price perfectly, clearly, because there are external factors. But what you can manage is investor expectation, and keeping investors informed. You've got quarterly reporting and people understanding what's happening at the company. So it might not, things don't always go smoothly. So things will go wrong, but rather than just trying to hide it, you need to be very transparent with your investors. And they accept that. They accept things don't always go right. As long as they understand where the company's going to, there might be some bumps in the road. So that's generally how you do that. But when it comes to kind of the exit bits, my view is, well, I've got a slight purist view, which I think an IPO is not about exit. It's part of exit. It's mainly around accessing growth capital to give you more growth going forward. So if everyone wants to exit on day one after a year, then that's a very, very bad signal. And the people should better crystallize some value, definitely. But they should also be thinking about the future and believing in the next 3 to 5 years of the company where they can make a lot more money. So getting investors to understand that, they can say, look, some of the management team are going to be selling X, Y, and Z shares for particular reasons, but they're in there for the long haul. You have to keep that otherwise you'll lose investor support, in my view. So all of this stuff is manageable, okay, but it's around hard work and managing the investor in the right way and creating a kind of, when it comes to the reporting, some of that's around automated process. So it's putting the management time in and automated process and having the right kind of advice. You do need independent advice. Without that, you will flounder. and you need CEOs who can actually be humble enough to listen to the advice.
Yeah, and tell us, another question that's come in is around the listing of tech companies versus traditional. Tell us a little bit about your experience of tech companies and some of those outcomes as opposed to traditional companies and how they fared relative to each other.
Well, in my experience, well, I talk about tech. I just did things like Deutsche Telekom, so that they could be described more utilities in my early career, and even British Telecom. But I found that a tech company hits the sweet spot of an institutional investor, because fundamentally institutional investors are investing for growth. You might have funds where a lot of the stuff is indexed, but they're looking for the sort of 5 to 10% where you generate significant growth. So they've got the skills to actually appraise tech companies, right? Which they across the world, actually, there's a lot of very, very skillful guys who are asset managers that understand tech companies. So that gives you a bit of a head start having investors that understand you. So generally, I think tech companies are perfect companies to come to public markets, because they will need follow on. They need to do M&A if they're clever. They need follow on capital raisings. And if you look at the example of the US market, I mean, the last few years, there obviously is volatility within it, but really all the growth in the market, the performance has been driven by large tech companies, right? That shows the importance of tech. So as long as investors get tech, as long as they perform, and there can be some forgiveness in the first 2 years, because people know these are growth companies in new industries. It doesn't just all happen straight away. If you can manage that and manage the investors in that 2 years, I think tech companies will continue to be some of the most successful companies on markets.
Understand. And, expanding the conversation a little bit into, obviously Pakistan Stock Exchange, we spoke to Farooq the other day, and, there's a great aspiration around listing, for example, certain Pakistani tech companies. There are also obviously some scaled situations now, nice, healthy book building, and a dual listing opportunity, perhaps even for some of those, if not a listing on PSX. In terms of your experiences of AIM, what are the key building blocks in making a strategy like PSX's actually work in a new market?
Well, I think the exchange has to do sort of things collectively to try and drive the. Firstly, I think I've met loads of brilliant guys from Pakistan in tech, by the way, which I found a little bit inspirational. So there's some great people. So that we're talking about big potential. As an exchange, you have to try and have investor days. Okay, so you promote days where you get sort of the top 20 interesting tech companies together and expose them to investors. You then need the companies to actually start understanding what it's like to be a public company. The main problem I see with tech companies is not the technology. It's often you've got a brilliant, charismatic CEO who can work very well in a private company, but as they go public, they need to change, and they need to be humble enough to create the support structures around them and have proper board members that can challenge them. That is a kind of human thing. If you need to be able to get over that hurdle, and I've seen that thousands of times, right? And you often have people who, the other part of it is people think they've got a great idea. They don't necessarily know the competitive context of that idea. They don't necessarily understand what the ultimate client base wants. They don't understand how to scale their business model. So you need the kind of business and financial strategy behind it and the supporting structures. So you need to socialize the idea, because I'm aware of loads of interesting Pakistani companies, but I don't think necessarily globally that is the case. But yeah, the exchange should be trying to promote Pakistani tech as a really exciting asset class, which I'm sure it has to be. But then also making sure there's a support structure so they can make the transition to companies which can succeed as public companies rather than have all the pitfalls which we talked about.
Fantastic. So what we're doing is,
and by the way, one thing, some of the costs I talked about earlier,
I
was talking about sort of large cap, large markets. So you can do it for significantly less in some of the kind of alternative markets around the world, which might be a first stepping stone for some of the tech companies.
Interesting. So what Martin and I have been doing is to start brewing the concept actually around an advisory practice focused on IPO readiness, specific focus being how do we support the Pakistani ecosystem, PSX? How do we support the Saudi and UAE ecosystem as driven by Tadawul and so forth? And how do we give active 90-degree insight, advice, advisory to companies looking to build the IPO path, and then to act actually as a project manager of the process, so that there is a degree of independence. I mean, we're working with banks and so on, but a degree of independence around the support structure for the management and board. So, I mean, I won't plug that because that's not the point here, but what I will do is, Ali Pai, if you could, we'll send you the deck around some of our thinking as elaborated on this call around IPO preparedness for CEOs who are looking to scale. And then, feel free, please, to circulate that to anybody who's interested, because we figured it might be an interesting way to do this first webinar on IPO, to go, let's accompany it with some content and then use the content as the basis for a follow-up discussion. Because as we discussed in our conversation with Farooq and with Raida, it was pretty clear that what we can do to support the PSX and the Pakistan Software Export Board will be very valuable to them. So, we're looking to do that, looking to support the Saudi ecosystem as well. Martin and I were in Riyadh, actually, on Monday with a large sovereign and with a key opinion former within the public space, board member, advisor, investor, etc. So a lot of momentum in the space, a lot of interest in the kind of capabilities which provide quality regionally, global and local advisory capability. And obviously we're available in any way, and Martin is as well, which is generous of him, to support anybody who wants to leverage the knowledge and start thinking about the IPO path as a founder or as a board member. Fantastic.
Yeah,
That's it. What is that? That's 9:59. Oh, brilliant. 59 minutes on the dot.
It's been a pleasure. Okay,
great.
And, I also understand cricket, which obviously is very important in the Pakistani context, even though the English cricket team is a bit of a disaster at the moment.
Absolutely. Great. So fantastic. Great stuff, Martin. And, look forward to continuing this discussion between ourselves and between the group, and look forward to some great content being posted by Ali and the team.
Thanks, guys.
Fantastic. Thank you.
Bye-bye.
Thank you very much, everyone.